as a channel that is focused mainly on the economy and the housing market, I think we would be remiss if we didn't take a shot at talking about inflation. Not only inflation coming up with the print in, or I don't call it middle of June, also the rest of the year, what is going on with GDP. And we might even throw in unemployment. And we need to have this conversation with the one and only Taylor from Life Goal Investments. How you doing, buddy?
Doing great. Thanks so much for having me. This is a volatile economy, a volatile news cycle that we're in. So this is ultra important. Let's get into it.
Yeah, the first thing I want to talk about is rates. Again, I look at mortgage rates a lot. I think we started last week at 6.5. We ended at 6.9, which is a wild move, all to the upside. And I actually think kind of a head fake because it's reacting to some noise from the Fed. It's reacting to the debt ceiling. I think all of that stuff will resolve itself in a week or two, but still, that's a huge move. That's going to slow housing down, less offers, more, days on market. It's going to have an impact. What did you see in rates last week?
Yeah, no doubt about it. And you start amortizing 6.9 versus 6.5 or whatever it is that you said over a 30-year mortgage. That is a ridiculous amount of money on a $400,000 house, which is the average home price. No doubt. Yeah, rates have been all over the place this year. It's funny because they have something called the MOVE index. So let me talk about stocks first. Stocks have what they call the VIX index, and this is much more widely followed. It's known as the fear gauge. So the higher the VIX, the more volatile stocks are, and generally stocks are going down as they're more volatile. So what
Okay.
you've seen this year is 20 is kind of that point of demarcation when it comes to the VIX. The VIX is cruising along right at like 15, 16, 17. 20 is when it starts to get volatile. And it hasn't really touched up against that. So the stock market is saying all is good, sanguine environment. But the MOVE index on the other side is the stock market, or is the bond market's version of the VIX, that fear index for bonds. Now, the point of demarcation for the MOVE index, where it starts to get volatile, is about 50.
Mhm.
Now, the bond index, the MOVE index, has been running at about 125,
Oh
a
my
two and
goodness.
a half time multiple, right? So stocks are saying all is well, and the
Yeah.
VIX and rates on bonds are jumping all over the place, saying this is a wildly uncomfortable economic environment that we're in. We need to take things really seriously and bet accordingly. And that bet has changed on inflation data, on debt ceiling data, all of the things that continue to come out on a week to week basis has the bond market really concerned, whereas the stock market on the other side is saying, we don't really care. These companies are going to be okay.
Yeah. It is pretty wild. Again, the 10-year I assume was up a lot last week. Again, I look at the mortgage rate a bunch, but
It was.
uh am I really think last week was caused by two things, and I think both of them roll off in the next 2 weeks. One is I think we both agree that the chances of a default are very unlikely, but also not zero.
Correct.
And I think the bond market is faster to price in non-zero than the stock market. The stock market's like, you got me last time, not going to happen this time. You all have figured out, in the last minute, I'm not going to sell because of your nonsense. The bond market's reacting right away. Is that
Yep.
fair?
And so to wrap some context around that, right now, as of this weekend, Barron's wrote an article on it. The odds on the debt ceiling not being lifted before it gets stumbled upon are 3.9% today. If you
Okay.
rewind back, the last time we really went through like a bunch of angst around the debt ceiling increase was back in 2011. The
Right.
odds on that at the same distance prior to the debt ceiling potentially defaulting was 6.7%. So they were taking it a lot more seriously back in 2011 than they are today. So, but yes, I definitely agree that, again, to the point the market is betting there's only a 3.7% chance of this playing out.
Mhm.
But we mentioned this a couple weeks ago as we initially started talking about the debt ceiling. Is it's funny, the market's not going to price it until they price it. That's a Yogi
Right.
Berra-ism there, right? I get
Right.
that.
Right. Right.
But what I'm getting at there is everyone thinks that this will happen at the 11th hour, right? Coming up on that June 1st-ish deadline when we stumble across the debt ceiling, all of
Right.
a sudden it will be taken care of and the Democrats and Republicans will come together on a deal. But if it doesn't happen, it's going to go from that, maybe it'll tick up to 5% at that point to
And
boom,
then you
it's
go
happened.
boom.
Yeah.
Yeah. Yeah. And then the other thing that obviously happened last week is you started getting more and more Fed presidents coming out talking tough, talking hawkish. Again, I've long tried to educate my channel. This is their job. They're trying to tell the market they're wrong. They don't want the market to price ahead. James Bullard come out today, who, oh, by the way, is a non-voting member, saying we've got 2 more rate increases. Neil Kashkari saying, hey, if we pause in June, that doesn't mean we hike in July. All these people talking tough. And again, I think the market's starting to get it and starting to price that in. Is that fair?
Yeah, again, to the point I made, I guess it was on the last conversation, is the reality is the Fed is starting to get the market to walk in their direction. So earlier on this year, as of just about 3 weeks ago, there were 3 rate cuts built in by the end of the year. Rate cuts, the Fed cutting rates. Now, the Fed on the other side is saying, we're not going to cut rates. In fact, we might increase rates between now and the end of the year, and we don't think cuts are likely. So again, the market was saying 3 cuts, and now they're going, okay, we're actually starting to see that the Fed is taking this really seriously. Now we're only pricing 2 cuts. So there's still a long ways apart in 50 basis points, 0.5%, where the market's saying things are and where the Fed's saying things are. But nonetheless, directionally, they're coming together. But it's interesting, that hasn't really been priced in the stock market.
Right.
Because with that, you would expect stocks to have sold off some. They have not. They've been on an upward trend over the past month. Whereas bonds on the other side, it's caused bond rates to tick up because less cuts means bond prices will start to have a negative effect.
I believe I saw this last week. I am not a stock guy by any stretch, but I believe the S&P, and I think it was the S&P, had a 52-week high on Thursday. Is that right? Something like that?
That could be correct, yes. And so you saw the low water mark on the S&P 500 in October of last year. So that would be kind of where that low water mark is. But the highs have obviously trailed off because it essentially perpetuated downward throughout 2022. So that could certainly make sense that a 52-week high could have been made.
Well, I guess so. I'm looking at my phone now again, CNBC. So it's the high of the year. So I stand corrected. The 52-week high is 43.25, and we're at, I'll call it 4,200. So I stand corrected. It was a year-to-date high.
Gotcha. But you're not far off, right?
Yeah, I'm not far off. Yeah.
Less than a couple hundred points.
Yeah, but the reason I bring that up is I don't think the Fed had a year-to-date high on the S&P 500 on their bingo card.
That's
really the point.
Nor do I. Yeah, the Fed is trying to get consumer and market behavior more in line with theirs, and they haven't successfully done that thus far. At least on the stock side. Again, on the bond side, they certainly have. The bond market's been much more reactive.
So I'm going to put something out here. This is my thesis, my opinion. This is my guess about what goes on with rates. I believe rates have their years there sometime between now and June 12th. We will see the high water mark for rates, both in mortgages and the 10-year. Why do I say that? Because I think everything goes the Fed's direction after the 12th. We will have a debt ceiling resolution before June 12th. Even if it defaults, it will default for hours, days, something will happen. We will start to get economic data, right? A week from Friday, we will get the jobs number for May. I think that will come in below expectations, perhaps even low, under 100,000. We will get CPI headline and core, which I think come in because of a large base effect rolling off, which, oh, by the way, we will have for 2 months in a row. Then we will get housing data start to roll off. We looked at Truflation earlier and saw that what is going on in housing. So I think for the next 4 months, inflation goes the Fed's way, and we end, CPI headline could be sub 4% in the next 4 months. So again, and we will get economic data being weaker. We will validate an earnings recession for a third quarter. Again, I think a recession we flagged is starting in Q2. So I think we just have 2 weeks of pressure, and then the rest of the year, we sort of come into this. That's what I'm guessing. What does that feel like?
I don't disagree with you whatsoever, and I normally do. So
yeah, that's true.
But what you're saying there in general is the economy continues to slow. That's
we're going to start to see evidence of it slowing. Yes,
correct. Yeah. So when it comes to rates, I think we've absolutely seen the high in rates. Now mortgages are a little bit different, and I'm not necessarily an expert there, but they do price off of inflation and the 10 to 30-year Treasury bond.
And I do spread, think but
I think and a spread off of that. Correct. Yeah, and I do think that we have seen the high water mark placed So the 10-year treasury was up at 4.25-ish in the cycle and has come down all the way down to the 330s ballpark. And now has popped back up to the 370s. So
Yeah.
I think that more than, directionally, I think the 10-year continues to trail off, because as the 10-year comes down, what that signals is a weakening economy. So right now it's kind of bucking the trend with that. And some of that has to do with the inflation data that's come in. But I think all in all, if you look at the broad landscape, rate of change, as you mentioned in the last video, is the most important thing to recognize as an investor. And I think the rate of change is certainly negative from an economic backdrop standpoint. So that brings rates down and eventually brings mortgage rates down as well.
Yeah. So to kind of put it in housing context for my housing friends, I think there's a chance Mortgage Business Daily or Mortgage News Daily will post a 7 handle on mortgage rates sometime in the next 2 weeks. But that will be the cycle high of the year. And we will slowly move in because economic data will weaken first. Then then it'll be reality, no more hikes. Then we will see the margin, which is a shockingly wide 313 basis points come in, traditionally 180. So I think everything will lead to lower rates at the end of the year, but we've got to get through the next 2 weeks. We got to get through the debt ceiling nonsense. It's not 0. Apparently it's 3.7%. Thank you, Barron's. It's just the next 2 weeks are going to be, just stupid, frankly, but we got to get through it.
Yeah, and I like that you pointed out the spread between the 10-year treasury and that of mortgage rates, because that is historically wide right now, and that is just a crusher.
Dude, it's 2 standard deviations. Crazy. We're not even a single deviation.
That's a function of 2 things. One is the banks didn't know where inflation was going, so they had to price it in aggressively on the front end. And the second part of that is the struggles that the banking industry is seeing right now, right?
Oh, yeah.
So they've said, hey, we're not going to drop these because we want more liquidity on our books in case we get a bank run like Silicon Valley Bank, like First Republic, like the others that have seen it. So they need to have that liquidity on their books. And to do that, they price a mortgage higher. If you do take that mortgage, they're going to make a good chunk out of your skin onto their balance sheet.
Yeah, exactly. Well, do me a favor, Taylor. You put out a lot of daily content to help educate and entertain. Where can people find you?
Yeah, thanks so much. Follow us at Life Goal Investments. We're on both Instagram and on TikTok.
Thank you, buddy.